it's Hoda, co-founder and CEO of StockCard. It's November 27th, 2019, and today we're starting a rather new series for our YouTube channel. Why? Because it's getting close to the end of the year 2019, and we have, as is tradition here around the StockCard, we are going to start reviewing the companies that we have on our watch list. And if you haven't seen our watch list in the past, you should definitely go to stockcard.io /portfolio store and click on our watch list. It's available to everyone. And as of today, there are 116 companies in this watch list that we use as a pipeline for picking stocks for our own portfolios. And my goal is that by end of December, come December 31st, I have a decision about all of these 116 companies so that we can start the 2020 with a new set of companies on our watch list. With that, I'm super excited to tell you about today's pick or today's stock review. I picked up this company. I went over my watch list and basically sorted them down based on worst performing stocks, based on their return, based on their stock gain. And then I wanted to focus on the worst ones first, and then we can gradually get to the best ones. And then hopefully some of these worst performing companies that have had negative returns since we added to our watch list are companies that we can pick them up and invest in them, and it's an opportunity to pick up good companies. So that's why I'm excited to start from companies that have had the worst performance since we added to our watch list. All right, the worst performing company on our watch list as of today is a company called Ferroglobe, ticker GSM. And today we're going to dig deep and see whether this company is a buy, watch list, or this company is a buy, watch list, or sell in avoid. Let's get to it. All right, welcome back. This is Hoda, co-founder and CEO of StockCard, and today we are reviewing Ferroglobe, ticker GSM. It's a company that we have had on our watch list in 2019, and it's the worst performing company on our watch list. So today we want to make a decision whether we get this company out of our watch list and cast away or avoid it altogether, or whether, because the company has been one of the worst performing and has the least maybe has the cheapest stock that is available to us, is one of the cheapest stock that is available to us, maybe we need to pick up a few shares. All right. The very first thing that comes to my mind in this company on companies, the StockCard, is that the company is in a stable industry. It has a rather stable operations, as it has underperformed the market. And investors are very pessimistic about the company. The thing I actually realized that the stock is now a penny stock. It's less than $1.06 per share, which tells me there's something significantly wrong about this company, about its operation, about this future. And chances are, if they haven't already received a letter from NASDAQ stock exchange, they may receive it soon, because this is now in the penny stock territory, and the companies that get into penny stock territory usually you lose their opportunity to be listed in the company in the stock exchange unless they can provide in some sort of a 90-day plan that how they can recover and go back to a financially more stable situation in order to continue to be listed in these big stock exchanges. So that's already a red flag that may say something about me about this company. So we need to figure out why the stock has been declining to get into a penny stock territory. And you can kind of see at some point earlier in the year, in February timeframe, it was above $2, and now we see it about 64 cents a share. The second thing that comes to my mind that kind of grabs my attention is that there are 4 updates about this stock in the past week or so. One is the sentiment has changed. The investors had a calm sentiment about this company, and now it's changing for the worse. And there's some short interest, but it's stable, so it's not that bad. And on November 24th, this sentiment was calm, and now it turned into pessimistic. And also RSI, Relative Strength Index, which is a technical indicator showing whether a stock is oversold or overbought, potentially, is become stable. So the stock is not neither oversold or overbought, but overall there's some concerns here by seeing that the sentiment of sentiment of investors has changed about this stock. I'm personally following this stock, obviously, because this is on my watch list. So it's a good thing I get notifications if something changes about this company. But let's really dig deep into what's going on in this company. And if you're not familiar with it, and I have to say, I don't exactly remember what this company is and why we added to our watch list. So I want to go to the key information section and kind of get to know what this company is. And apparently it provides silicon and specialty metal, specialty chemical, aluminum, solar, steel, in iron foundry industries. And it's only $100 million in market capitalization. And interestingly, when I'm looking at key dates about this company is a dividend paying company. Had the last ex-dividend was September 30th, and they haven't yet announced their next earning ex-dividend date, by the date that you need to own the company to get paid the dividend. But and their next earning release is actually coming up. So December 2nd is their next earning release date. And that tells me why the sentiment here is becoming negative. Depending on what the financial analysts are expecting about the company, just a few days before the quarterly earnings, you usually see a change in the sentiment of the company's forwards, or for better, depending on what they're expecting to happen. So chances are, because the sentiment is now negative and the earnings release is just coming up on December 2nd, investors are expecting the stock gonna even underperform compared to where it is right now. Okay, so it probably is it's a company that produces coal, in metal, like uses coal or charcoal or some other metal, raw material, to support manufacturers, let's say in the steel industry or in a specialty chemical, or aluminum and things like that. Okay, so let's see what's going on with the company from an operational point of view. And I see sales growth is positive. That's interesting. The company last fiscal year was growing by 30%. And what is bothering me right now is that the current fiscal year revenue growth is expected to be at 28%, negative 28%. So something, again, that's not unsurprising to see that the investors are pessimistic about the stock, because sales growth is expected to decline significantly this year. And let's see if they have any sort of cash availability issue. And maybe short term they're okay. They don't have any short term liabilities or concerns, but the company has some long term debt, and unfortunately its free cash flow is negative, which is again another concern for me. Because as you remember, when we were looking at the key dates, this is a dividend paying company here, and it's already have a negative free cash flow. That tells me there might be something going on, and they have some going on with their dividend, and whether they can keep paying the dividend considering their negative free cash flow and their declining sales. So that's why I want to click on the stock performance bucket and go and see what's going on with their dividend. Well, dividend is positive, and if I click, to 10%, above 10% dividend yield. So you may say to yourself, this is a dividend paying company that pays more than 10%. And it's been, investors are so pessimistic about the stock that the price has probably gone to a undervalued range, which is true because based on the company's last 12 months price to sales ratio, it's only priced at 0.06x or time its sales, x or time its sales, and the company's price, it's only about 0.2 times the company's book value, whatever it is has on its financial books from a book value. And if you look at its price to sales ratio, it's significantly undervalued. So what is going on with this company as of now, that this is just sort of in this very strange situation? Pays 10% above dividend. Investors are very pessimistic about it, and the stock is undervalued, and there is a significant decline in the company's revenue growth. So just before jumping into any other investigation about this company, what I feel is going on here is that this used to be an interesting company, and they were growing sales, and the company that was just doing very well and started paying dividend to its investors. But something probably happened in an industry or in the company, and the sales has been declining, and the company's revenue has been declining, and the earnings, most likely the earnings has declined significantly. That's why the earnings per share has been declining significantly. It's in the red from positive to negative, and that's why the dividend yield, which is basically only dividend over per share over earnings per share, has been increasing significantly to getting to that 10% yield. So what I would want to know is just to investigate and see whether this stock can survive and maintain its dividend, and more importantly, can it just kind of recover from this penny stock status that it's been dealing with. So if I go to the company's investor presentation segment on their website, on their investor relations website, I went ahead and downloaded their latest quarterly their second quarterly earning report, and kind of wanted to see what's happening. And then just sort of scrolling down, the first thing that came up was that the Q2 results reflected continued slowdown in the end market demand and weak pricing environment. Successful closing, they're basically divesting some of their divisions, and then they're trying to focus on improving their operational and financial flexibility. So here's what's happening with this stock, most likely, is that they're just struggling with some sort of a demand issue globally. And that's what driving the sales, and that's what's causing them trouble in having a solid financial, and they're probably divesting from some of the divisions that they have. Also, I went ahead before just jumping on the call and downloaded their latest investor presentation report, which they presented in November this month, actually, to some of the investors in Budapest. And as I scrolled down, what became apparent is that the company is dealing with challenges in a coal industry. So basically, the Western producers who use the company's product are transitioning to more renewable sources. So because this company produces its material and its product using coal and charcoal and things like that, as an input material for silicon, and in steel manufacturing and in solar panel manufacturing, but it is dealing with issues coming up related to sensitivity about renewable sources of energy and renewable sources of material in the Western world, and most likely they're also being impacted by everything that is happening in the world as it relates to trade war, demand for silicon, inputs and material to go into silicon, it's basically just declining or is becoming very volatile, and that's why probably it's causing a lot of trouble for this company. Yeah, here as you read it, this report that they provide, they have problems with coal burning, especially in Europe. They can't keep doing it. There are a lot of now strong sentiment against using coal and coal burning, and international investors are moving away from coal assets. So that's not surprising. If a company is making most of its production or product basically using coal, that's probably something of some sort of a trouble for this company. So that's really explains what's going on. And that is most likely a trend that is not going to change anytime soon. So even if the company managed to kind of just go through these cyclical changes in demand for material for production of silicon that we've seen in some other industries, it still has to deal with the overall cyclical trend, not even cyclical, overall industry trend, to move away coal and move towards more renewable sources of material and energy and things like that. And something interesting as I was just scrolling down came up here is that they talk about China has gaining strength in the market that they operate. So another thing that we need to be worried about for this company, sort of a trend that is not impacting them, that it's not under their control, but it's impacting them, is strength of China. So China probably coming up with more modern manufacturing facilities and processes to produce input and raw material for production in silicon and all the other industrial applications. So on one hand, they have to deal with transition. On the other hand, they have to deal with things like China coming up with more modern manufacturing facilities for these kind of raw materials. And I gotta tell you, by looking at what's going on in the industry and their own investor presentation, and looking at what's available on StockCard from visualization of their operational industry and stock performance, I am concluding that this stock is not worth watching anymore. And it is in the penny stock, and we just saw that they're trying to focus on creating operational flexibility. So I'm expecting that they cannot keep up that 10+% positive yield that they're paying to their stock holders and And overall, my decision as of today, right now, is to get this company out of my watch list. And I think we may want to get back to this company if it ever get a chance to recover operationally. We may want to get back to it and then reevaluate it. But as of today, in November of 2019, I do not plan to hold to the stock of this company. Okay, so I'm trying to get it out of. Here we go. I'm gonna delete it, remove it out of our watch list, and I'm glad that we made this decision today. Thank you very much for being with me, reviewing Ferroglobe, ticker GSM, and with this stock from our watch list. And make sure to subscribe to our YouTube channel, because in the next couple of days and weeks, we're going to review 116 stocks together and clean up Stock Card's watch list together. And if there are some companies that are on your radar and you'd want me to have a look and review on one of the latest, one of the upcoming episodes of our YouTube channel, please put your comments and your request in the comment section of this video. Subscribe, put a comment, and don't, of course, forget to sign up for Stock Card. It's free. Stockcard.io. That's where you can find us and sign up for free again. All right, thank you very much, and I'll talk to you soon. Bye.